Hello and welcome to SNR Property Seasonal Market Report. My name is Rick Annunziata, and today I'm going to be walking you through a few of the most important topics in the housing market right now. We'll be talking about home ownership as a hedge against inflation and rising mortgage rates. And if you haven't done so, check out our website blogs where we talk about using real estate as a retirement tool. So let's get started. So I'm going to begin with the first topic, home ownership as a hedge against inflation. Now, why is this important for us to be talking about? Well, as we see prices rise around us at the gas pump and at the grocery store, home ownership is certainly not immune to that in any way. And neither is rising rent. And we're going to be talking about that as well. But one of the things we want to focus on is how locking in someone's fixed monthly cost, their mortgage, is the biggest cost that they have in home ownership. At today's price is so beneficial to safeguarding someone or, hedging against that inflation and that rising cost around us going forward. I want to begin with a quote here from Investopedia in this slide. And it says, real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So what we can see here is that home ownership is one of those things that you can lock in the cost today, and it's an asset that's increasing in value in time. And as prices rise and home values rise and all the prices around us rise, locking in that fixed cost in home ownership is really a game changer. It's a hedge against inflation tomorrow. So what I want to do in this next slide is to show you a visual that really, depicts what we're talking about. Home ownership outperforming inflation over time. So let's take a look at that slide. So this is home ownership as a hedge against inflation. And I want to break it down for you so you can really see what we're talking about here. This is home price appreciation versus the consumer price increases over the decades. And it goes all the way back to the 70s. Now, what you're looking at here is the blue bars are the average inflation rate for the decade, and the orange bars are the average home price appreciation for each of those decades as well. So let's look at the 70s to start. Inflation increased at 7.1% in that decade, and home values appreciated at 9.9% in the same time period. So home ownership outperformed inflation. And where do you want to be in inflationary times? In that asset that's outperforming inflation. Now, in the 1980s, a little bit more balanced, 5.6% and 5.5 home price appreciation. And look at the 90s. We start to see home values tick up, again, a little bit more, outperforming inflation throughout the decade. Now, we know the 2000s were very different. Home prices performed at a very different rate than what we've seen in many other decades, and even what we're seeing today and potentially tomorrow. We also had a fundamentally different housing market. We had the oversupply of homes. We had, lending standards that were vastly different than they are today. And homeowners didn't have the equity that they have in their homes right now. So fundamentally, a really different market where, we're not heading going forward. So home prices did not outperform inflation in the 2000s. But look at the 2010s here. This is where home values really started to kick in. Homes started appreciating much faster than inflation, 4.9% versus 1.8%. And then 2020 and 2021, what's happened here? Massive home price appreciation, a drastic difference from where home values outperformed inflation. So over time, what you can see is that home ownership is generally looked at as this great hedge against inflation because home values are performing better than the inflation rate. And that means that someone buying a home today can lock in today's cost and protect themselves against the rising cost of inflation and that biggest monthly payment going forward, their mortgage. Now, this really becomes important when we start to talk about renting because renting takes on the risk of rising rental prices year after year. And we've shown you that data if you've been following along with us, how rental prices are truly skyrocketing. So let me share a quote here with you that's really powerful for renters. It says, and this is from Bankrate, and it says, a fixed rate mortgage allows you to maintain the highest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payments remain the same. And that's certainly not the case if you're renting. And that's because rental prices rise year after year. And so this becomes really powerful for someone who might be sitting here going, I could buy today, but I'm going to kind of press pause and I'm going to wait. I'm going to wait and see what happens to home values. Well, if they drop or if they rise, I'll wait it out. Well, all the forecasts that we've seen show that home values are projected to do what? To continue to rise and not to fall. We also know that mortgage rates are projected to keep rising, and we know that rental prices are rising. So what does that mean at the end of the day? Well, someone who continues to rent but could buy is taking on the additional increases in rent year after year. Plus, it's going to cost more to buy a home down the road. So really important for renters to understand this dynamic. And I think this next visual really helps show how rental prices compare to the inflation rate. So this slide here shows that the rent increase has been greater than inflation in most years. So let me break it down for you. Rental price appreciation versus core inflation rate, again, going all the way back to the 70s. So your blue line is that core inflation rate, and your orange line is a rental price appreciation. And what do we see as a whole? The green line higher than the blue line in most scenarios, meaning that rental prices have increased at a faster rate than inflation in most time. Yeah, there's some ticks down there below the blue line. However, that means it's more expensive to rent over time because rental prices are continuing to rise faster than the rate of inflation. So when we have this conversation with renters, it becomes mission critical that they understand the dynamic of buying now, if they can, to avoid these increasing costs of rent and inflation all around us. So let me go ahead and share this quote. And I think this really kind of brings it home for us. It says this, and this is from Forbes: Homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. They locked in that payment at today's cost. Tangible assets like real estate get more valuable over time. And you've seen that in the graphs and the data we've shown you, which makes buying a home a good way to spend your money during inflationary times. You know, we've talked a lot about home price appreciation, and I'm sure you want to know, where is that headed as we have this conversation and we think about rising prices and how homes aren't immune to that? That's for certain. So let's take a look at this next graph from the Home Price Expectation Survey. And I think this gives you a real clear picture of where home prices are projected to head, according to the experts. Now, the Home Price Expectation Survey is a survey of 100 economists, data analysts, people who are projecting out home price appreciation in the fourth quarter of last year. This is the projection for the cumulative house appreciation by 2026. So what are you looking at? Well, they divided out the groups into optimists and pessimists. Optimists being the ones projecting the most appreciation over the next 5 years. And then we have the pessimists estimating on the lower side. So take a look at that orange bar. Those are the pessimists. You know, the experts that are saying home price appreciation will be on the lower side. Cumulatively, by 2026, it's going to be over 23%. So as the experts look forward to the condition of the market, what's projected to happen? Home values are expected to increase in value over time, even on the lower end. 23% is pretty significant over the next 5 years. So locking in today's cost is mission critical for those who have the opportunity to do so, to protect themselves in their largest monthly payment. Because as we know, with home prices rising, mortgage rates rising, inflation all around us, it's going to get more expensive to purchase a home. So let's talk a little bit about mortgage rates. And here we are at the beginning of February, and certainly we've seen a rise in mortgage rates in a volatile environment. So I'm going to cover where we're at today. As economic recovery continues going into the spring and the summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that home buyer demand continues to be elevated as supply remains slow, driving higher home prices. I'd expect to see the Fed to raise rates in March, and we're looking at right now about 3.5% on an average 30-year fixed mortgage, as recorded by Freddie Mac. But no doubt a volatile January leading into a February that I believe will see more rise in rates, and that's what we need to be prepared for. So my goal over the next 2 minutes is to give you what you need to accurately communicate that. As mortgage rates rise, we do expect some moderation in housing demand. causing house prices growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale will keep the housing market very competitive. No doubt we'll see a housing market that is competitive this year, and this is very important for buyers and sellers to be aware of. It goes on to say in 2022, we expect purchase originations to grow while refinance activity is anticipated to decrease. And why is this important? Well, there are two mortgage markets. You have the purchase market, you have the refinance market. The purchase market is forecasted to grow, and the refinance market is forecasted to constrict. And that makes sense, right? In a rising rate environment, people are less apt to refinance. Most people refinanced at a record low rate, and good for them, as homeowners be able to do that. But we're going to see mortgage volume constrict. Buyers and sellers both need to be aware of that as they make their real estate purchases or sales. The mortgage purchase market is going to grow while the refinance market is going to constrict. News about the mortgage market constricting does not indicate less home sales taking place. Now, as far as interest rates go, I think this slide says it all. You know, if you take our current rate of 3.5% and even going into maybe 4%, which I think we'll see soon enough, we're still having a very, very favorable rate when you go all the way back to the 70s. This slide here shows the average 30-year fixed by decade going back to the 70s. Today's rate is very, very favorable, like I mentioned, when you look at things historically. You know, I've mentioned it before, between 2010 and 2020, we bounced around 3.5% and 5%, which is the range of interest rates during that time. You see the average rate here during the last decade of 4.09% was very, very good financing. So it's going to feel like we're heading higher, but we look historically, still very good financing for homes across the country. So the last few slides that I want to show you really kind of positions us on what we need to be as educators in our industry. Now, this slide here is a look at the 10-year Treasury, going back to the beginning of December. Just 2 months ago, and what do we know? During that time, the rate of the 10-year Treasury yield has skyrocketed, knocking on the door right now of 2%. So why is this so important? Here's why it's important. For the last 50 years, the relationship between the mortgage rate and the 10-year Treasury yield has been almost symbiotic. Wherever the 10-year Treasury yield goes, there goes the 30-year fixed rate. What we want to watch closely is the 10-year Treasury yield. And you can see that relationship in this slide all the way back to 1972, as both mirror each other very closely. So something for buyers to look at is the impact of rising interest rates. I would take the average loan amount in your area and do some simple calculations. What was the payment at the beginning of the year? What's the payment now? And what's the payment at 4%? Is going to show you the real impact of moving interest rates. And I'm going to end right there. Thank you so much for joining us in the S&R Properties Market Report. And I have one quick update for you. We have our spring and buyer and seller's guide coming out on March 4th, 2022. And this is a fantastic resource available on our website for the spring market. And thank you for joining with us today. And I hope those guides you download really help you out. And take care. Thanks for listening.